Hey everyone, I just wanted to create a brief video. I don't know actually how brief it will be, but explaining ORIS and IRIS. So, as many of you know who are part of my Discord group, Synthetic Yields Investors Club, I like to run a strategy. One of them is ORIS, stands for Option Rental Income System. And then the other one is IRIS. I call it the Insurance Reinsurance Income System. This one, ORIS, is basically a poor man's covered call strategy. So that's also known as a diag. I can never spell diagonal. Null spread. I know I that's wrong probably. And then IRIS is a put credit spread, really. I like to think of this as like my insurance business and this as my short-term rental business. And try and explain that in just a second here. But the two of them work together. And so this video, I just kind of wanted to explain how I think about this. And actually, I usually start with ORIS first when I'm looking at a particular stock or ETF that I want to make money from, right? And I'm usually looking for things that are undervalued so that the downside is somewhat limited. So if I show you a chart here, this is just purely an example of a stock that I was looking at, Match.com, which many of you might have heard of Tinder or used Tinder. It's a dating app. Match.com is probably the largest dating website app company in the world. They own Match.com, a bunch of other popular dating websites in different niches and age groups. Anyway, they've got a pretty good business going, and I think that they're undervalued. Now, don't take any of this as investment advice. This is just for educational purposes. So I want to show you kind of how I would go through the thinking process. So number one, I'm constantly screening and looking at different stocks. I have an app for the Synthetic Yields Investors Club. If you're a member, you have access to the app and it helps you find some of these opportunities. You can filter based off of fair value, off of price, things like that. And so Match is actually one that came up in the filter as a good ORIS candidate. So what I would do is then look at the chart, right? And so this is, chart going back to August of last year. If I were to zoom out, this is just a screenshot of the chart. If I were to zoom out, you would see it had a very long downtrend. It's come down a lot over the last year. And then so that you got this downtrend line here. And so from a technical standpoint, it looks like it's actually at least bottoming. It had the kind of the lows down at the end of December, went on a rally. It's kind of retraced back. And if I put my fibs up, and for those of you who aren't familiar with Fibonacci retracement lines, you can do some research. Look up Fibonacci retracement and you can get some information on it. But stocks tend to retrace once they've made an up move or down move. They tend to retrace back to these fib levels. So the popular ones are 382, 38.2% retracement, 50% is this middle line, and then 618 is also another popular one. So now you can see today it retraced pretty much to the penny to the 618 retracement line, which is at 44.82. And I forgot I do have a pen so I can kind of highlight this. So it retraced there. And so you generally tend to find some support. So there's kind of three types of support, maybe four. You've got your general price, like looking at the chart, if I say where are potential levels of support, that's where the price has bounced off, levels that the price has bounced off of quite a bit. So you can see, if I drew a line here, you had a lot of bouncing off over here. You did dip below it here. But even here, you kind of bounced off of it for a few days, even here, right? So this is a potential support price level. That's one type. A second type of support can be your moving averages. So these ones are exponential moving averages, I believe, on this chart. You could look at that, or you could look at the simple moving averages. You'll oftentimes see support around those moving averages. It's a dynamic support line. So you can kind of see, even on this 50-day exponential moving average, that was kind of acting as support for a few days there before it broke today. And it also will act as resistance, right? You can see through here is kind of resistance. So we don't really have any simple moving averages or SMAs, EMAs acting as support right now that I can really see. Way up here, you've got like the 200-day. And so that's not in our favor right now on this particular name. So that's the second type of support. And then your third type of support would be these fibs, right? So you can see there is potentially going to be some support here at the 618 fib, which is of the fibs, 618 and 50% are probably the two strongest. And so it very well could just hang out here for a while. And your fourth type of support is like trend line support or resistance. You can see this trend line here. And if you were to zoom out, the stock price kind of did respect the trend line for quite a bit. I don't really see necessarily any trend line support here right now. You could argue down here, this is trend line support, that line there. Anyway, enough about support and resistance. So suffice it to say, I'm kind of looking at this and saying it's got some support here, and then maybe another level of support here, and then if that fails, ultimately back to the all-time lows at around 38.64. Right now, today it's trading at about $45. So if I were interested in taking a position and maybe I thought it might continue to fall back to one of these lower levels, if I did not want to initiate a Portman's covered call yet, then I will first look for an IRIS trade, which is a put credit spread, right? And a put credit spread, it's like insurance. So you're going to insure the stock at a certain level. So let's say I decide I would be interested, I'd be willing to insure the stock at $42 because I think there might be some support there. So I will be willing to buy somebody shares at $42, essentially is what you're doing when you sell a put, a $42 put, right? And then you may want to buy some reinsurance for yourself. So you'll buy another put down here at, let's say, like the 38 level. Okay. So you sell this put and you buy a put here. So you're selling insurance to somebody, whoever buys it from you, they want the protection, $42. And then you're buying protection down at 38. Okay. And so, let me look on my other screen here. Actually, I can get you the real numbers. So if I were to do a 30-day, it's actually 28 days, about 28 days out to the March 10th expiration. If I did that, sold the 42 and bought the 38, it looks like I could get an $81 credit right now. And that's a $4 wide spread, right? We sold the 42, bought the 38. So I would be getting 81 and I would be risking about $319, right? Almost with commissions and stuff, it'd be 320. Because that adds up to 400, which is the width of your spread. So it's a pretty decent percentage return there if it stays above that price. So I might do that trade, this IRIS trade. And if the stock, let me put the stock price in green. So let's say the stock price, comes down a little bit lower, goes back up, and then by, let's pretend we're at this March 17th expiration, this red dotted line. Let's go with that expiration. By then, if as long as it's above $42, even if it came down here right and touched the 42, as long as it expires with the stock price above $42, I get to keep this $81 of insurance premium. Now that's my net insurance premium, right? Because I probably collected more than that here, but then I bought insurance here. And so the net of it was 81 bucks. Okay. Now, let's say it gets down to $42 and now it's at my target price, right? At this point, it's now lower. It's at 42 instead of 45, so I may be willing to start an ORIS position. So my second step here might be to start an ORIS position, which is really a poor man's covered call, also known as a diagonal spread, where I'm buying a deep in the money leaps call, usually around 12 months left until expiration, as a proxy to buying 100 shares of stock. And then I will sell typically a 30 DTE at the money call. So I would sell the at the money call. So if I were to do this, and I'm just pulling real numbers here, and I'm going about a month out, I can collect for selling, I have to guesstimate a little bit, but an at the money call, I would collect about $250. Let's just say $250, right? So I would get $250 for selling a 30 DTE at the money call. And for that leaps call, I like to go at least 85 delta deep. So I could buy like the $30 strike call. Sorry, if it was down, okay, let's just say 85 delta deep would cost me it wouldn't be the 30 strike because the price would have gone down. So it would cost me about, let's just say $1,900. And what I'm looking at right now. So I would spend $1,900, right? And the net of that is I'm spending about $1,650 initially to put on this ORIS trade. And what ends up happening is this $250 decays over time, and I collect that as rent. Essentially, I like to think of it as rent that I'm collecting on the leaps call. I'm renting my upside out to somebody for 30 days. So if the stock explodes up, congrats, they win, they get the upside, but I still collect the time value, which for an at the money call is the entire value of the call at the time you sell it. So I'm collecting that $250 of rent no matter what. It will decay to zero in 30 days. Even if the price appreciates, even if the price goes down, I still collect that. So here I would essentially collect $250 at the money, right? And if the stock price, let's say the stock price moves down, okay, to about $40 here at the next option expiration, which is this red dotted line, 30 days spaced apart, I could then I would still sell the call up here at my original 42, but because the price is now lower, it's not at the money, this makes it an out of the money call, I would collect less, right? And so if I look, I could see approximately, if I was $3, $2 out of the money because it's at 40, I would still get about 170 bucks. Okay. So I still collect 170 bucks here. And then let's say the price, let's say it goes down even further. Say it goes down to this 38 level. Okay. At that point, my original 42 call, right, is that strike price is $4 out of the money. So if I were to sell $4 out of the money call today, I would get about 100 bucks. So I would still be able to collect 100 bucks here of rent, by selling that 42 call, even though the price is down at 38. And then let's say price goes back up so that at this expiration, it's back at about $42, which is at the money, right? And we know kind of the at the money premiums we can collect $250. And then let's say at the next, it keeps going up, and at this expiration, it's at $46, which is $4. This would make the 42 call $4 in the money. And so when it's out of the money or in the money, you get less than the at the money rent. Your time value is less. So a $4 in the money, that would give me about $100 too. Because recall down here, when we're $4 out of the money, we collect $100. When we're $4 in the money, we also collect about $100. Okay. So you can see over 1, 2, 3, 4, 5, over 5 months, we've collected, let me do the math really quick, 500, 600, 700, 870. Is that what we all get? Collected $870, right? And our initial investment was, the net investment on that first month was $1,650, right? And so, I mean, if we just look at the leaps call, I guess maybe that's a more accurate way to say it. If you look at it, the leaps call cost us $1,900 is what we said for that 85 delta leap. Now this is going to have decayed a little bit, so maybe your leaps call, depreciate a little bit, but maybe by $100 or something. So it could still be worth. So you might have to knock off. My point is, let me put this back. So your $1,900 investment, but you might have had like $100 in depreciation of time value, but you have very little time value on that leaps call, so you don't depreciate much. So over 5 months, maybe $100. So still might profit like $770 net profit off of $1,900, right? Which is still a substantial return. If I just pull my calculator here, that's still a 40% return in about 5 months. Okay, which is, it's great. We target 30% a year. So things won't always flow this nicely, right? Because price could go down a lot further or up a lot further, and that would make it so you collect less rents. And if it goes up, a lot, you can't collect hardly any rent selling back at the original strike price. So I tend to, at a certain point, I'll just close out the entire trade and you got to find a new one. But that's a good problem to have. Anyway, I hope this video helped you understand kind of ORIS, the interplay. ORIS kind of is, think about it as a wheel strategy, right? ORIS is kind of the put leg of that wheel strategy, and then ORIS is the you buying the shares and selling calls leg of the strategy. But I just do it a little bit differently. I found that the risk profile is a little bit better. You actually have a built-in stop loss when you're using options versus shares of stock. So if you have any questions, feel free to reach out to me, and enjoy your day.